Capital market line displays risks and returns from combinations of risk-free assets and a well-diversified portfolio. The diversified portfolio should include all sectors in the economy. There are generally two main steps in portfolio management. 1. Maximize diversification, and 2. Decide an acceptable level of risk. The diversified portfolio is the fundament of capital asset pricing model. A well-diversified portfolio should already have included the asset the investor is considering investing in, asset A, making extra demand for asset A equal to 0. For a well-diversified investor to want to include additional weight of asset A in his or her portfolio, the risk premium needs to be satisfactory. To illustrate the capital market line, we will start by making different combinations of S&P 500 and the risk-free asset. The same way we did when we were drawing an efficient frontier consisting of combinations of stocks and bonds. We will use the same layout. Copy this area here. Paste. Change the text. S&P 500. Risk-free. Change the formula. Weight of the S&P 500. Multiplied by the arithmetic return of the S&P 500. Plus weight of the risk-free asset. Multiplied by its return. Press F4 here and here. Drag down the formula. Since we are combining the S&P 500 with a risk-free asset, the standard deviation will only be the weight of the S&P 500 multiplied by the standard deviation of the S&P 500. Press F4 here. Drag down the formula. And move this a little. We will insert the data into a graph. Here. Insert. Scatter. This one. Select data, add CML. X value will be the standard deviation and Y value will be the return. Add some labels. This is the capital market line. It shows risk and returns from combinations of risk-free assets and a diversified portfolio, in our case the S&P 500. The point of the capital market line with the highest Sharpe ratio is where you hold only the diversified portfolio here. This is the highest return from taking one extra unit of risk. The difference between the capital market line and the capital allocation line that we have made earlier. In capital allocation line, it shows combinations between the risk-free asset with a risky portfolio. In our example, the risky portfolio was the stock portfolio and a bond fund. The point with highest Sharpe ratio is where you have 71% of your capital in the stock portfolio and 29% in a bond fund and 0 in the risk-free asset. This gives the highest risk and return trade-off. Capital market line shows combinations between the risk-free asset with a diversified portfolio. The point with the highest Sharpe ratio is where you only hold the diversified portfolio. This is where you have the best risk and return trade-off.